Good evening, my dear friends. Good evening, all. So, myself here, Tarun Gupta. Today, we are discussing the revision. We are doing the revision of chapter 21, the NR taxation. So, as you know, that there will be a question from this chapter in your exam and highly practically relevant and from exam point of view also very relevant chapter. So, let's start. Very interesting and very easy chapter. We'll do it and you will realize that it's too much easy. The international taxation part is quite scoring because the content is less and the weightage of this content is more in your exam. So it's kind of a low hanging fruit which you can catch very easily. Okay, so let's start with the non-resident taxation, which is chapter number 21 of your ICAI module. We start from we will revise from the module itself. Okay. So the first topic is residential status. We have studied this in our IPCC as well. We'll just revise it. So residential status. At first, let me know why it is relevant to determine the residential status. Residential status help us to determine the quantum of income which is to be taxed in India. What all income is to be taxed in India is dependent upon the residential status of a person. So, our ultimate objective is to compute tax liability. For this, we need the income which is taxable in India, and to determine the taxable income, we need a residential status. So, residential status of individual. Yeah, one thing. As we know, the income tax is a yearly concept. Every year we have to compute the taxable income, the tax liability for that year, and therefore residential status is also computed every year. It may happen that a person may be resident in year 1, he may become non-resident in year 2. Now, residential status of individual. So an individual becomes a resident in India if either he is in India for 182 days or more during the relevant previous year, or he is in India for 60 days or more during the relevant previous year, and 365 days or more during 4 years immediately preceding the relevant previous year. Okay. It says an individual resident, if he stays in India during the relevant previous year for 182 days or more, or during the relevant previous year he stays only for 60 days or more, but then he was in India for 365 days or more during the 4 years preceding the relevant previous year. Okay. These two we call basic condition. If an individual satisfies any one of these basic condition, then he qualifies as a resident in India. So what are the basic condition? If the individual is in India during the relevant previous year, the previous year for which we are determining the residential status for 182 days or more, or he is in India during the relevant previous year for 60 days or more, but in this case, he was in India in the last 4 years for 365 days or more. So for the second condition, you need to see the period of stay of the individual during the relevant previous year, and also period of stay of the individual during 4 preceding previous year. And for the relevant previous year, the limit is 60 days or more, and for the 4 preceding previous year, the limit is aggregated stay should be 365 days or more. Okay, but for the condition of 1, we only see the period of his stay during the relevant previous year. Okay, and if an individual satisfies anyone, either 1 or 2, anyone, then he will qualify as a resident. If it does not satisfy both of these conditions, he does not neither satisfy the condition number 1, 182 days or more, nor satisfy the condition number 2, 60 days or more plus 365 days or more, then he will qualify as non-resident. But once an individual becomes a resident, the story doesn't end here. But if he becomes a non-resident, the story ends. But if he qualifies as a resident, then we have to see whether he's a ROR or RNOR, resident and ordinary resident, or resident not ordinary resident. How we see this? If a person satisfies both these conditions, 1 and 2, then he is ROR. If he doesn't satisfy any one of these conditions, then he is RNOR. And what are these two conditions? These two conditions is for determining whether the resident is ROR or RNOR. We don't need to see his stay in the current previous year. We need to see his stay in the preceding previous year. So what are two additional conditions? One is he must be resident in India in at least 2 out of 10 years. 2 out of 10 preceding previous year. And he is in India for 730 days or more during last 7 years. If he satisfies both these conditions, then he will be treated as ROR. If he does not satisfy even one of these conditions, then he will be treated as RNOR. We call them as additional condition. What are additional condition? The resident, the individual who qualifies to be resident, should be resident in India in at least 2 out of preceding 10 years, and he has to be in India for 730 days or more during last 7 years. Aggregated. So, in case of basic condition, if an individual satisfies even one of the basic condition, then he will qualify as a resident. But for additional condition to qualify as ROR, resident, ordinary resident, he has to satisfy both the additional conditions. Now, what do you mean by stay in India? The stay in India includes the stay in the territorial waters of India. It's not necessary that stay has to be continuous. So the aggregates, we have to see the aggregate stay during a previous year. It's not necessary that stay has to be continuous. Yeah. And the date of departure and date of arrival, both are considered as stay in India. Okay. So in respect of the time when you are landing or when you are flying off from India, both the days, the date of departure and date of arrival is considered as stay in India. This point becomes relevant when there is a borderline situation. Okay. Now the second condition. This second condition is not applicable in respect of 3 types of individual. One, an individual who is an Indian citizen, and who leaves India during the relevant previous year as for employment outside India, or an Indian citizen who leaves India during the relevant previous year as a member of crew of Indian ship. Lastly, an Indian citizen or person of Indian origin who, being outside India, visit India during the relevant previous year. So you're getting my point? Yes, sir, we are getting your point. So first we discuss when an individual would qualify as resident if he satisfies any one of the 2 basic conditions. If he becomes non-resident, story ends, fine, he's a non-resident. But if he qualifies resident, then we have to see whether he is ROR, resident, ordinary resident, or RNOR, resident, not ordinary resident. How we see this? If the individual who qualifies as a resident satisfies both these conditions, both the following conditions, then he will qualify as ROR. If he does not satisfy even one of the additional conditions, then he will be RNOR. What are these additional conditions? He must be resident in India for at least 2 out of preceding 10 years, and he must stay in India. He must be in India for 730 days or more during 7 preceding previous years. Okay. Now, the law gives a benefit to 3 types of individuals. What type of benefit? It says that these 3 types of individual will qualify resident only if they satisfy condition number 1. So condition number 2 shall not apply. Even if they satisfy condition number 2, still they will be treated as non-resident. So who are these individuals? One, he is an Indian citizen who leaves India during the relevant previous year for employment outside India, or he is an Indian citizen who leaves India during the relevant previous year as a member of crew of Indian ship. So in both these cases, they will qualify resident only if they stay in India during the relevant previous year for 182 days or more. You with me? The third condition is, the third type of individual is he is Indian citizen or person of Indian origin who being outside India visits India during the relevant previous year. So he's settled outside India, he's coming in India during the relevant previous year only for a visit, not for permanent settlement. Then he will qualify as resident only if he is in India during the relevant previous year for 182 days or more. You are with me? If he satisfies the second condition, still he will not qualify as resident. Meaning thereby, if these three individuals, even if they stay in India during the relevant previous year for more than 60 days, and their aggregate stay in India during the last 4 years was exceeding 365 days, still they will not qualify resident. They continue to be non-resident. An individual would like to be a non-resident. Why? Because the scope of taxation, scope of total income is limited in case of non-resident and is widest in case of ROR. Now, who is a person of Indian origin? Let's understand one more point. Who is a person of Indian origin? An individual is said to be a person of Indian origin if he or either of his parent or any of his grandparent, means dada, dadi, nana, nan. So if he, the individual, or any of his parents, the mother, father, or either or any of his grandparents. So out of this 7%, if any one of them was born in undivided India, undivided India means India, the present India, Pakistan, Afghanistan, Nepal, Bhutan, all this. If any of out of any of these 7%, if anyone was born in undivided India, then the individual is said to be person of Indian origin. So, Mr. A, his mother, his father, and mother and father of his father, and mother and father of his mother. So out of these 7 people, if any one was born in undivided India, then Mr. A would qualify as a person of Indian origin. Okay. So, if an individual or person of Indian origin who being outside India means he's settled outside India, if he comes on a visit in India during the relevant previous year, then he qualifies resident only if his stay in India during the relevant previous year is for 182 days or more. However, for third category of person, the Indian citizen person of Indian origin who is coming for a visit, there is a proviso which says that if his Indian income means the income which accrue or arise in India, or income which is deemed to accrue or arise in India, of course, and income from business which accrue or arise outside India but which is controlled from India. If its Indian income exceeds rupees 15 lakhs, then second condition shall apply to this individual, but only with the modification that instead of 60 days, there would be 120 days. So I explain you. So if the individual has an Indian income exceeding rupees 15 lakh, then he will qualify resident in India when either his stays in India is for 182 days or more during the relevant previous year, or second condition will apply because his income exceeds 15 lakh. In case which income? The Indian income. And what is the second condition? It applies with a modification that his stays in India during the relevant previous year is 120 days or more, and he was in India for 365 days or more during last 4 preceding previous year. Okay, so instead of 60, it is 120. Okay, now I explain again. Assuming there is a Mr. A who is an Indian citizen and who is settled outside India, who comes for a visit during the 11 previous year. Now, if his Indian income is up to 15 lakh or more than 15 lakh. If it's up to 15 lakh, then second condition will not apply and he will qualify resident only if his stay in India during the relevant previous year is 182 days or more. But if his Indian income is more than 15 lakh, then he will qualify resident if his stay in India during the relevant previous year is 182 days or more, or his stay in India during the relevant previous year is 120 days or more, plus his stay during the last 4 preceding previous year was 365 days or more. You understand? So for the third category of individual, we have to see his Indian income. If his Indian income is up to 15 lakh, then same thing. He will qualify resident only if he satisfy condition number 1. Condition number 2 shall not apply to him. But if his Indian income is exceeds 15 lakh, then condition number 2 shall apply, but with a modification that instead of 60 days, we have to see the 120 days. Okay. And one more thing, if this individual, the individual whose Indian income exceeds 15 lakh, becomes resident owing to because of this condition, because he satisfies the second condition, 120 days or more, plus 365 days or more, then he will always be RNOR. Even if he satisfies the additional condition, still he will qualify as RNOR. So in your exam, if the individual becomes a resident because of this condition, because of condition number 2, 120 days, then you need not to apply the additional condition. You can straight away say that he is RNOR. Okay? Because even if he satisfies the additional condition, his status would be RNOR. Okay. Now, what we mean by Indian income? So, Indian income means income which accrue or arise. It means which is not a foreign income. So, now what is a foreign income? The foreign income means income which accrue or arise outside India, except income from a business controlled from a profession set up in India. So, you understand? So, Indian income means income which accrue or arise in India plus income from business controlled from India or income from profession set up in India, even if accruing outside India. So only income which accrue outside India shall be considered is that of business which is controlled from India or that of profession which is set up in India. Okay. Now, in case of Indian citizen who is a member of crew of a ship, the CBD said that in such cases, there is CDC, continuous discharge certificate, which is being made in respect of each individual in the ship. So the date on which he joins the ship, which is entered into this CDC as the date of his joining the ship, up to the date he leaves the ship as entered in the CDC. This period is deemed to be period of stay outside India, including the date of joining and date of leaving, provided the ship is engaged in eligible voyage. So eligible voyage means it's running in an international traffic, meaning thereby if the originated port is in India, the destination port is outside India, or if the originated port is outside India, then the destination port must be in India. Okay. There's a benefit given to an Indian citizen who is a member of crew of a ship. In his case, the period he joins the ship up to the period he leaves the ship is treated as his period outside India. Okay. The only condition is that ship should be engaged in eligible voyage. Eligible voyage means international traffic. Lastly, deemed resident. Deemed resident means if you are an Indian citizen and your Indian income. Similarly, Indian income means the income accruing arising in India plus income accruing from business controlled from India, professional setup in India, which do accrue arise outside India. If your Indian income means an income other than foreign income. Indian income exceeds rupees 15 lakh and you're not liable to tax in any other country, then you will be deemed to be resident in India, deemed resident. So in the Indian citizen, if your Indian income exceeds rupees 15 lakh and you're not liable to pay tax in any other country, then you will be deemed to be resident in India. In this case, also if you become a resident because of this provision 61A, then you will always be RNOR. Okay. But deemed residency will arise only if you don't satisfy the condition of section 6.1. You don't become resident by qualifying any of the basic condition. If you become a non-resident, if you do not satisfy both the basic condition, then you will see whether you satisfy the condition of deemed residency or not. And what are the conditions of deemed residency? There are three conditions. The individual should be Indian citizen. His Indian income should exceed rupees 15 lakh. By Indian income, it means income accruing arising in India plus income accruing from business controlled from India, profession set up in India. This we see only when the person does not satisfy either of the basic conditions. What do you mean by liable to tax? Liable to tax means there is an income tax liability on such person in that country under the laws of that country, and it shall include a person who has subsequently been exempted from such liability. So if there was a liability on such person to pay the income tax, but subsequently because of some exemption, he has been exempted from the payment of income tax in such country, then also he will be considered as a liable to tax. He will not be considered as not liable to tax. 6(1) is applicable if you are not liable to tax. Okay. Like in India, there is no tax on the people residing in Leh because of the weather. So it's not that they are not liable to Indian income tax. They are liable, but subsequently they have been exempted. If you see under section 6(1)(a), there are only three conditions to satisfy. And if you satisfy all the three conditions, you become a deemed resident. Indian citizen, Indian income exceeding 15 lakh, not liable to tax in any other country. So the condition whether you need to stay in India is not there. So 6(1)(a), you can become deemed resident and thereby RNOR, even if you stay in India for 0 days. Stay in India is not necessary for being a deemed resident. So if a resident can become ROR or RNOR, he becomes an ROR if he satisfies both the additional conditions, which are he is resident in India for at least 2 previous years out of preceding 10 previous years, and he has been in India for 730 days or more during 7 years immediately preceding the retirement previous year. And the person, if you remember, the third category of individual who visits India, he shall also be RNOR if he qualifies to be resident because of the 120 days day condition. And if you are deemed resident, then also you will qualify as an RNOR. So this completes our residential status of individual. Okay. Now we'll shift to the residential status of HGF. So an HUF is resident if any part of its control or management is situated in India. Even a small part of its control and management situated in India, then the HUF will said to be resident in India. If control management of its affairs situated wholly or partly in India, even a part of the control management situated in India, then the HUF is said to be resident in India. It's said to be non-resident if its entire, if the control management of its affairs wholly situated in India. Okay. So even a single reason was taken in India, then the HUF will qualify as a resident in India. What do we mean by the control management? Control management means the head and brain, not hands. What I mean by this? Head and brain means the place where the decisions are taken, not hands, not the place where the decisions are executed. So what is the element? Which place where we have to, which we have to see where the actual decisions are being taken, not the place where they are implemented. If they are even a single decision are taken in India, then the control management is partly situated in India and therefore HUF is resident. If the entire control and management is situated outside India, all the decisions to run the HUF business is taken outside India, then the HUF is non-resident, irrespective of the fact that the entire business is run in India. So where the activities are performed is not relevant to determine the control and management. Control management means where the brain, the head and brain of the entity sits. Control refers to the central control and management and not carrying out day-to-day business by servant, employee, or agent. You understand? Controlled management of a business is said to be situated at a place where head and brain of the adventure is situated. In case of HUF also, if it becomes non-resident, the story ends. But if it qualifies resident, then we have to see whether the HUF are OR, resident, ordinary resident, or are NOR. So if Karta satisfies both the additional condition, then the HUF is ROR. If Karta of HUF does not satisfy any of the one additional condition, then the HUF is RNO. And what are the additional conditions? Same as we discussed in the case of individual, which is, the Karta should be resident in India for at least 2 out of preceding 10 previous year. The Karta should be in India for 730 days or more during 7 years immediately preceding 12 previous year. If Karta satisfies these 2 additional conditions, then the HUF is ROR. If Karta does not satisfy even any of these conditions, then the HUF is RNOR. So, residential status of HUF, you have to see if the control and management of affair situated wholly or partly in India. If answer is yes, then the HUF is resident. If answer is no, then the HUF is non-resident. But if HUF becomes a resident, then we have to see the 2 conditions in respect of Karta of the HUF. So whether Karta was resident in any 2 previous years out of 10 previous years, and was Karta in India for 730 days or more during the last 7 previous years. If answer to both this question is yes, then the HUF is ROR. If answer of any one of this question is no, then the HUF is RNOR. Okay. So residential status of other entities. So for other entities, AOP, BOI, local authority, firm, LLP, all other entities except the company, they will qualify as resident only if the control management of its affair is situated wholly or partly in India. So similar to HUF, if any part of their control management is situated in India, then the entity shall qualify as resident. If the whole of the control management of such entity is situated outside India, then it shall be qualified as non-resident. So the definitions are wide in a sense, they intend to make the person resident. So even a part control or management of the affairs of the entity will make that entity a resident in India. And remember one more thing, that the concept of ROR and RNOR is applicable only to a individual and HUF. For all other entities, they are either resident or non-resident. So once they become a resident, the story ends there for other entities as well. We don't need to see whether the entity is ROR or RNOR. The concept of ROR or RNOR is relevant only for the purpose of individual and HUF. So for other entities, AOP, BOI, local authority, firm, LLP, property societies, whatever. So they are either resident or non-resident. When they are resident, even if the part of control of management of their affair is situated in India. When they are non-resident, if whole of the control and management of its affairs situated outside India. Okay. Now the company. This is the most important part for your exam from this chapter. So residential status of a company. A company is resident, again, similar for the company as well. The company will either be resident or non-resident. Once you become a resident, we will not go for ROR or RNOR. So it's either R or NR. Story ends. Okay. A company is resident if it's an Indian company. Means it's a company incorporated under the Indian Companies Act 1965 or 2013. Or either it's an Indian company or its place of effective management in that year is in India. So if it's an Indian company, then by itself, by default, it's a resident in India. But if it's not an Indian company, means it's a foreign company, then the foreign company will qualify as resident in India only if its place of effective management, we called it POEM. Place of effective management in that year is in India. If the POEM of foreign company in the relevant previous year is in India, then the foreign company will qualify as resident. And we know once a entity, once a person qualifies resident, his global income, entire global income becomes taxable in India. Okay. So if a if you are an Indian company, you are incorporated in the Indian Companies Act, then by default you are a resident in India and your global income is taxable in India. But if you are a foreign company, then we have to see where your poem is, place of effective management. If your poem in that year is in India, then the foreign company will qualify resident in India and the global income of foreign company shall be taxable. Even the income accruing outside India shall be taxable. Once if it is established that the poem of the foreign company is in India. Okay. What is a poem? Poem means a place where key management and commercial decision. Key management commercial decision, the important ones, very important one. Key management and commercial decisions that are necessary for the conduct of business of an entity as a whole are in substance made. So, where we say that the poem of a company is situated, it's situated at a place with a key management and commercial decision of the company that are necessary for the conduct of the company as a whole are in substance made. So the poem gives an importance of the substance, not to the form. So where the key management and commercial decisions are being taken, key management commercial decision means again we are talking about the hardcore brain of the company, not the executory part. So where these key management commercial decisions are taken, at that place it will be said that a poem of the company is situated. And if that place is in India, then the poem is in India. If that place is outside India, then the poem is outside India. Okay. So for a company, if you are an Indian company, yes, you are resident. If you are not an Indian company, then you are a foreign company. Then we have to see whether your poem was in India during the relevant previous year. If answer is yes, then also you are resident. If answer is no, then you are non-resident. Now, how we determine the poem? This is the most important part of our topic register status from exam point of view. So one thing, as by the definition, the concept is substance or form. We have to see in substance where the decisions are being made, not in form. Okay. And to determine where the poem of the company is, there are some guidelines. These guidelines, firstly, the guidelines apply only in respect of company whose turnover exceeds rupees 50 crores. Okay. So we are not talking about the small companies. So if your turnover exceeds 50 crores, then we have to see at first where is your active business. Are you carrying on active business outside India? Means we are determining the poem of a foreign company, because if you are an Indian company, there is no requirement to determine a poem. So if you're a foreign company, you can become resident only when your poem is in India. So first, we will ask a question whether the foreign company is carrying on active business outside India, whether the company is engaged in active business outside India. Now, how we determine whether the company is engaged in active business outside India? There are four conditions. If the company satisfies all these four conditions, then we say that it is engaged in active business outside India. If the company does not satisfy even one of these out of these four conditions, then the company is not carrying on active business outside India. So for all these are cumulative conditions. This and in between them. So to say that a company is engaged in active business outside India, A, B, O, I have to satisfy all these four conditions. What are the conditions? The first condition is the passive income should be up to 50%. The passive income should be 50% or less. Secondly, the asset in India should be less than 50% of the total asset. Then employees who are resident in India or who are situated in India should be less than 50% of the total number of employees. And lastly, the payroll expenses on these employees, whose employees? On the employees who are either resident in India or who are either situated in India. The payroll expense incurred by a company on these employees should be less than 50% of the total payroll expense. Okay, you're getting my point? Yes, sir. You understanding? Yes, yes, I'm understanding. Good, good, good. So let me revise. Uh, for a foreign company to determine a poem for a company, I have to see whether the company is engaged in ABOI, active business outside India. To understand, to see, to determine whether the company is engaged in ABOI or not. If the company satisfies all these four conditions, then we said the company is engaged in ABOI. If it does not satisfy any of these four conditions, then the company is not engaged in ABOI. What are the four conditions? The passive income should be 50% or less of the total income. Then secondly, the assets in India should be less than 50%. The employees who are resident in India or who are situated in India should be less than 50%. And lastly, the payroll expense on these employees should be less than 50% of the total payroll expense. If you satisfy these four, all these four conditions, then you are engaged in active business outside India. Otherwise, you are not engaged in active business outside India. What is the relevance of this? We will discuss in a minute. So what are these four conditions? Let me repeat. The passive income should be 50% or less. The total asset in India should be less than 50%. The employee resident situated in India should be less than 50%. The payroll expense on these employees should be less than 50%. Now, what do you mean by passive income? The passive income, what do you mean by income at first? Income means the taxable income. If we are talking about the foreign company, remember, no? All these things we are doing it for the foreign company. Because in case if the assessee is an Indian company, it's by default a resident. So the concept, the requirement to determine a poem arises only in case of foreign company. So we are determining whether the income, the passive income of a foreign company is up to 50% of its total income. Now, what do you mean by the income? Income means the taxable income as per the tax laws of the country in which the foreign company is incorporated. Or if there is no tax law, there is no tax in such company. Maybe you may call it as a tax haven. There are countries which do not levy income tax. Earlier it was a Dubai as well. So if there is no tax in the country in which foreign company is situated, is incorporated, then total income means the income as a books of accounts. So if the foreign company is subject to tax, income tax in his home country, then the income means the taxable income. If there is no tax in the home country, then the income means income as a books of account. Okay. Now the assets. What do you mean by asset? In case of depreciable asset, I take the average of opening and closing. In case of non-depreciable asset, I'll take the value as per books of account. No average. Employees. Again, for the employees, I have to take the average of opening and closing for both. See, in every this thing, in each of these four conditions, I have to compute two figures. For one, I have to compute passive income and total income. So for this, how will I compute the total income? If the company is engaged, is subject to tax in its home country, then taxable income. If it's not subject to tax, then the accounting income as a books of account. Now comes to the assets part. I have to compute the assets situated in India and total asset, right? Only then I will able to compute the percentage. For computing asset in India or the total asset, I have to compute opening and closing assets. Okay. So if the assets are depreciable, then I take the average opening or closing. If the asset is not depreciable, then I only take the asset closing asset as per books of account. Similarly, for employees, I have to take the average opening and closing. And remember one more thing: employee include person who though are not employed, formally not on the payroll of the employee, but they perform functions similar to the employee. So even the contractual employees are considered employee for this purpose. Payroll expense include everything: salary, basic, allowances, perquisite, including pension and social security, social cost borne by the employer. Now, important part: what do you mean by passive income? Passive income means that part of income which is arising from a transaction where both sale and purchase are from associated enterprise. So I'm buying goods from associated enterprise and selling good to associated enterprise. Income from this transaction is called passive income. So buying should also be from associated enterprise from AE, and selling should also be to AE. If buying is from AE and selling to third party, then not a passive income. If buying from a third party and selling to AE, then not a passive income. Passive income means buying from AE and selling to AE. If both the transaction, buying and selling, both are from or to AE, then the income from this transaction is passive income. Other types of passive income are royalty, dividend, capital gain, interest, or rental. So aggregate of these two income is called passive income. And this passive income must be up to 50% of the total income. So what are passive income? If the income from a transaction where both purchase and sale of goods or service are from or to AE. So if purchase is also from AE and sales is also to AE, then the income from this transaction is passive income. Okay. And if even one of the parties is not AE, then the income is not passive income. Other types of income are royalty, dividend, capital gain, and interest and rental income. But if the assessee is engaged in the business of money lending, money business of banking or public financial institution, then interest is not considered as a passive income. Okay. So we have to see whether first, whether the foreign company is engaged in active business or not. For this, we have to see whether the passive income is up to 50% of the total income. The asset in India is less than 50% of the total asset. The employees in India is less than 50% of the total employees, and the payroll spent on the employees in India is less than 50% of the total payroll cost of the entity. If all these conditions are fulfilled, then the entity is said to be engaged in ABOI, active business outside India. So once you are engaged in active business outside India, once it's proved that you are engaged in active business outside India, then if we have to see where your majority of board meetings are happening. I'm not concerned about all the board meetings. If majority of board meetings are happening outside India, then POEM is outside India. So POEM of a company engaged in ABOI shall be presumed to be outside India if the majority of board meetings are held outside India. If out of 5 board meetings, 3 were held in Singapore and the company is engaged in active business outside India, then the POEM is said to be outside India, not in India. So, firstly, to determine a POEM, first see whether the company is engaged in active business outside India or not. For this, you have to see the 4 conditions. Condition of passive income, total assets in India, employee in India, payroll spends on the employees in India. Okay. If the company satisfies all these 4 conditions, then the company is said to be engaged in active business outside India. Okay. If company is engaged in active business outside India, then we see where the majority of board meetings happen. Majority of board meetings. Not all. Majority of board meetings. If majority of board meetings happen outside India, then the POEM is outside India. Even if some of the board meetings were held in India, not relevant. If company is engaged in active business outside India, and majority of board meetings held outside India, majority means more than 50%. Majority of the board meetings held outside India, the company is said to have a POEM outside India and therefore non-resident for India purposes. However, if it is proved that board meetings are mere formality, they are only in the form, not in substance. So board is not taking key management or commercial decision in substance. They are only approving the decision taken by some other person. Then in such case, such other person is resident in India. Then we say that POEM is in India and therefore the company is said to be resident in India. See, if I tell you practically where the risk of POEM in India arises. It normally arises in case of Indian MNC. So if the holding company, say Infosys, or say Adani Enterprise, is Indian companies, and they are the holding company. They have subsidiaries all throughout the world. Singapore, Malaysia, Dubai, everywhere, US, UK. So what happens is the real challenge is in respect of these subsidiaries. which have their holding company in India. So generally, the control of these subsidiaries are in India. The key management commercial decisions are generally taken in India. And if it's proved that the poem of these companies are in India, then the global income of these companies shall be taxable in India. But what the assessee wants, assessee wants that poem should be stayed outside India. Therefore, they continue to remain as non-resident, and therefore only their Indian income is taxable in India. Their other foreign income is not taxable in India. So they say what the law says. In this case, assuming all decisions, all key management commercial decisions are actually being taken by the Indian holding company, and the board of the foreign subsidiary company is only merely and as a formality approving this decision, then where the majority of board meeting held has no relevance, this question has no relevance. In this case, the poem of the subsidiary company, the foreign subsidiary company, is shall be said to be in India. Okay. So what says? In case the board is not exercising its power, and such powers are being exercised by a holding company or any other person who being resident in India, the poem shall be considered to be resident in India. Understood? So if the company is engaging activity outside India, then we have to see that what where the majority of the board meetings happen. If it happen outside India, then poem is outside India. But this condition would fail if it is proved that board is standing aside. It's not doing its function. The function of the board is actually being done by some Indian company or some Indian resident person. In such case, the poem shall be said to be in India, and the company shall be deemed to be resident in India. Now it says that, see, in a multinational groups which have a lot of subsidiaries in different countries, there are some standard operating procedures. In case of banking, payroll, IT, so they set up some standard operating procedure which is being followed by the entire group, by all the entities within the group, by all the subsidiaries and holding companies. If board is following such standard operating procedure in respect of payroll, IT, banking, computer hardware, etc., then we cannot say that the board is standing aside. Their general decision. We have to see who is actually taking the key management commercial decision. Always remember, the substance matter more than the form. So merely because the board of directors follows general and objective principle of global policy of the group, that does not constitute a case of board of director standing aside. Okay. Okay. So when we decide whether company is engaged in active business outside India, for this we compute the income, assets, employees, and we have to compute this for 3 previous years. For the current previous year and the preceding 2 previous years. For the 3 previous years, we will take the average of 3 previous years. However, if the entity is in existence for a shorter period, then we will compute this for a shorter period. Okay, there may be a situation that the accounting, the year which the company follow, is not same as the financial year, as the previous year. Then in such case, we take the period, the year which closes immediately before 1st April. Assuming the company is qualified, the guideline previous year is 25-26, and the foreign company follows calendar year. Okay, so to determine the whether company is engaged in active business outside India or not, we will see which period. This period is 1st April 25, the calendar year which ends just before 1st April. So it will be 31st December 24. So we will see the figures of 22, 23, and 24. The calendar year, these 3 calendars here, we see the figure. What if it is the company is not engaged in active business outside India? If the company is not engaged in active business outside India, then we have to do 2 things. First, we have to identify the person who are actually taking key management and commercial decisions for the company as a whole. And then we need to identify the place where these decisions are being taken. So place where decisions are taken would be more important than the place where such decisions are actually implemented. So we are talking about head and brain. We are not talking about the hands. So determination of poem, whether companies engage in active business outside India, company fulfilling the test of ABOI. Yes, poem outside India if majority of the board meetings held outside India. However, if de facto decisions are of decision-making authority is not board of director, but Indian parent or resident, then poem is in India. If company is not engaged in active business outside India, meaning thereby it fails in any of the four conditions we discussed. Then we first identify the person who are making key management commercial decisions, then determine the place where these decisions are in fact being taken. Now, what is ABOI? Just a quick revision. Is a passive income is 50% or less total of the total income. Less than 50% of total assets is Indian assets. Less than 50% total number of employees situated or resident in India. And payroll expense incurred on these employees, is less than 50% of total payroll expense. If all these four conditions are satisfied, then the company is said to be engaged in active business outside India, otherwise not. We have just studied what is passive income, where income from a transaction where both purchase and sale are from the associated enterprise or to the associated enterprise, and income in the form of royalty, dividend, capital gain, interest, and enter. So there are some guiding principles where how we determine. See, poem is a substance where actual decisions are being taken. Okay. So generally, these decisions are being taken by the board of directors. But sometimes the board of directors delegate their power to some committee, executive committee, or to senior managerial person. Then where the board meet will not be relevant, where the members of executive committee meet or where the senior management person meet and decide shall be the place where the poem shall be. Okay. If the board has delegated their power to executive committee, the delegation may be either de jure, may be formally delegated by a board resolution or something, or de facto. De facto means there is no formal delegation, but in practice, it's seen and that it is proved that the executive committee actually takes a key management commercial decision based upon the actual conduct of the board. Yeah. So if there's a formal delegation, we call it de jure. If there's not a formal, but based on the conduct, it is apparent, then we call it de facto. Location of head office is very important for determining the poem. Generally, the poem is a place where the HO is situated. But nowadays, many decisions are taken using the modern technology like the VC and or. In such case, where the place where director or the person taking decision or majority of them usually reside may be relevant for determining the poem. If the decisions are taken by way of circular voting, then we need to determine the person who has the authority and who exercise the authority to take decision, who are actually taking the decision. The place where such person are located is more important. See, there are a lot of decisions which the shareholder has to take as per the company law, whether to shut the company, whether to substantially sell the assets of the company, whether to deregister the company from the stock exchange, the modification of rights attached to the shareholders. All the decisions has to be taken by the shareholders. So these decisions are not relevant to determine the poem. Where the shareholder take decisions are not relevant. We need to see the decision Which decision? Key management and commercial decision, not the decision taken by the shareholders. Okay, but there may be a situation that shareholder may be exceeding their jurisdiction and taking the key management commercial decision. In such case, where the shareholders take these key management commercial decisions shall be the place where the poem of the company is situated. So getting my point, what we are up to? So whenever a question comes, so very simple question comes from this topic. First, we have to see whether the company is engaged in active business outside India or not. If the company satisfies all the four conditions, then we see where the majority of the board meetings are happening. If the majority of the board meetings happen outside India, then the poem is outside India. Then only the question comes is only limited to this. But if the company is not engaged in active business outside India, then we need to see two things. We first identify the person who are taking key management commercial decisions, and then we identify the place where the key management commercial decisions are actually being taken. All these things, who is taking key management commercial decision is a question of a substance. Generally, the decision is taken by the board. But if it's proved the decisions are not taken by the board, then we have to identify the committee or the person who are actually taking this decision and see where the decisions are actually being taken. Again, day-to-day routine operational decisions are not relevant at all. The execution is not relevant. Remember, we are talking about the head and brain. We are not talking about the hands. A decision to open a new manufacturing facility is a key management commercial decision, or discontinue a major product line will be example of key commercial decision affecting the company as a business of the business, affecting the company's business as a whole. But a decision by the plant manager to appoint a senior management to run that facility concerning repair and maintenance, the implementation of company-wide quality control and HR policies will be example of routine operational decisions which are not relevant for determining FOIA. If the above factors do not lead us to a conclusion where the poem is, then we can take help of some secondary factor. What are secondary factor? Where the main and substantial activity of the company is being undertaken, and where the books of account or records of the company are being kept. These factors are not at all relevant to determine where the poem of the company is situated. So the fact that foreign company is subsidiary of the Indian company, not relevant. The fact that the foreign company has a PE in India, not relevant. The fact that one or more of the directors of the company reside in India, not relevant. Where they reside is not relevant. The relevant is a place where the key management commercial decisions are taken. If they are taken by the directors, then where they meet to take the decision is the place where the poem is. Okay. So the above principles are not to be seen with reference to any particular moment. They have to be seen over a period of a time. So we don't follow a snapshot approach. Whenever holding a foreign company to be resident in India has a very major consequence because its global income will become taxable in India. Okay. So therefore, whenever there is a question whether a company, whenever as an AO, the tax officer wants to ask a question that where your poem is, that question has to be asked with the prior approval of PC or Commission of Income Tax. And if it is to be held that the foreign company has a poem in India, it is to be held with the approval of collegium of three members, all of whom are principal commissioner or commissioner. This collegium is formed by the chief commissioner. And of course, before holding a company to have a poem in India, an opportunity of being heard is given to the foreign company. We discussed in the starting, these guidelines apply only in respect of a company having a turnover of 50 crore or more than 50 crore. So they don't apply in respect of company having a turnover of 50 crore or less. Let's revise very quickly. So poem is a concept of a substance. We have to see the substance, not the form. who are actually taking the decision. If the board is only approving the decision on paper, not relevant. Where the brain of the company actually functions. Tax follows real power, not the paperwork. So substance over form. To prevent, why poem exists? To prevent company from avoiding Indian tax. You understood? So there used to be a subsidiary of a Indian holding company. Indian holding company used to have a complete control and management of the subsidiary company. But they, on paper, they show that the control management is outside India, and therefore they used to escape the Indian taxation. Definition. Key reasons. What type of reason? Commercial and management commercial reasons for a business as a whole. Total in substance. This is the place where these reasons are taken, shall be the place where the poem is. So, what is the litmus test? Who decide, go, stop, and change direction for the company? The place where these reasons are taken in respect of a company is the place where the poem is. These small things, and it retains in your mind. So, therefore, we are doing this. What are the examples of key management commercial decisions? Whether to enter a new market or to exit an market or not, about the capital structure, pricing policy, appointment of a CEO, annual budget. All the reasons seems to be a key management commercial decision. These are normal payroll routine decisions. Payroll, accounting, entry, HR administration, and factory operations. Delegation of execution is allowed. But if you delegate the thinking, then we have to see where you have delegated. So if the thinking part is of the board of directors, but if they are not doing this, they have delegated this, then the poem will be the place where this power is delegated. So board standing aside means board exists only on paper. Real decisions are taken somewhere else. So poem shall be the place where these real decisions are actually being taken. Example, foreign board meetings held, but Indian promoter approves contract and budget. Poem in India. So though meetings were held in foreign, but all the contracts and budget are approved by the Indian promoter on poem in India. The board is standing aside. Modern technology, physical meetings is relevant. Location of the final decision maker is relevant. If there is an active business outside India, then poem is abroad if majority of the board meetings happened outside India. Majority. Exception, if it is proved that board is standing aside, then the presumption break, then the poem shall be the place where the decisions are being taken. So it's taken by the Indian holding company or some person resident in India, then poem in India. There are three types of people in the company structure. Shareholder, not relevant for poem, because if they are taking the shareholder decision reserved for them. The board of senior management, these people are actually have a duty to take the key management commercial decision. They are the poem there. We have to see where these people are sitting. But person engaging operation, not relevant. Head office generally said to be a place where the poem is. So where senior management usually works, meets and return to. Return to means if they go to some other place, where they return to. So if they return to one place, that place shall be the head office. Strong poem indicator. What does not decide poem? These factors not relevant to deciding where the poem is. Place of incorporation, Indian ownership, the fact that the company is owned by Indian company is not relevant. If it has a P in India, not relevant. If it has a routine support function in India, not relevant. So if there's a foreign subsidiary and if the pricing and strategy decisions are being taken in India, then there's a risk that company may have a poem in India. So first identify the decision maker, then identify decisions. It should be the key management commercial decision. Identify the location where the decisions are being taken, and that location is the poem. The poem is a place. Poem follows power, not paperwork. Substance or form. Always remember, poem is a concept of substance, not a form. Okay. So this we discuss residential status of all the entities. Individual, HUF, the concept of ROR and RNO is only relevant for individual HUF. Then other entities, AOP, BOIR, AJP, local authority, firm, LLP. Then lastly, the company. Company resident if it's an Indian company or its poem in that year is in India for the foreign companies. Then we see how we compute the poem, how we determine the poem. So first we decide whether whether foreign company is engaged in active business outside India or not. If the company is engaged in active business outside India, then we see where the majority of the board meetings are happening. If they happen outside India, then the company is said to have a poem outside India. How to determine whether the company is engaged in active business outside India or not? If the company satisfies all these 4 conditions, then it is said to have engaged in active business outside India. If its passive income is up to 50% of total income, the asset in India is 50%, if less than 50% of the total asset, employees situated in India or employees resident in India is less than 50% of the total employees, the payroll expenditure on these employees who are resident or situated in India is less than 50% of the total payroll expenditure. If a company, foreign company satisfies all these 4 conditions, then it is said that the company is engaged in active business outside India. Okay. If the company is not engaged in active business outside India, then we see who are the person. We identify the person who are taking key management commercial decisions, and we identify the place where these decisions are being taken. If they are taken in India, then the poem is in India. If they are taken outside India, then poem is outside India. Okay. In case of foreign company engaged in active business outside India, we will not consider its poem outside India if its board is standing aside. Means board is not doing its function and they have either de jure or de facto delegated their power to some other person or some other committee. Then the committee or the person who are actually taking the decision shall be relevant to determine the poem. Okay. Now here comes the taxation part. Once it says, if a foreign company for the first time becomes resident in India, then there will be difficulty. Then global income shall be taxable in India, right? Yes, sir. Yes, sir. Beautiful. Then there will be difficulty in computing total income. What difficulty? For computing total income, we have to allow the depreciation expense. Following depreciation, we must compute the opening WDV. How will you compute opening WDV? If the company has brought forward losses in the foreign country, whether such losses can be set off against this income or not, whether the income of the foreign company is subject to TDS or not. So all these problems arise, and therefore the CBDT issues a notification. It says that we understand if a foreign company becomes a resident for the first time, there's an issue in computation of income, treatment of unabsorbed depreciation, set off carry forward, set off of losses, collection and recovery of taxes. So what they say? Now take one thing at a time. About opening WDV. How to compute the opening WDV on which depreciation shall be allowed in India. So it says if the foreign company is assessed to tax in its home country, in the country in which foreign company is incorporated. If it's subject to income tax in its home country, then WDV means the open WDV as per the tax records. Okay. But if it's not assessed, then open WDV shall be WDV as per books of account. Okay. What about brought forward losses and unabsorbed depreciation? If it's assessed to tax in the home country, then the brought forward loss or depreciation as per the tax laws of such country. If it's not assessed, then the brought forward loss or depreciation as per books of account. So very logical, simple, nothing tough. Yes, sir. Okay, so it says that the losses shall be eligible to be carried forward set off as per the Indian tax rules. That is for 8 years only. And this 8 years shall begin from the year when the loss was first incurred in the home country. Okay. And also one more thing, very important, that these losses, these earlier year losses, can be set off against the current year income, but only of such income which has become taxable in India because of poem. See, it's a foreign company, okay, and it qualifies to it happens to have a poem in India during relevant previous year 25-26. Okay. Now there may be a situation that this foreign company may be deriving some interest, royalty, FTS from India that was taxable in India even when it qualifies non-resident. But now since it has become resident, in addition to this income, which was in any way taxable in India, whether the company became a resident or not, these income were in any way taxable in India in the hands of foreign company. Now other income will also become taxable. Now the law says the losses which you can, the brought forward losses of the earlier years of the which the entity incur in the foreign country can be set off only against these other income which has become taxable only because of the poem. These losses cannot be set off on this. On this, the company shall continue to pay taxes. Because had the company not been held to have a poem in India, then also it would be paying taxes on interest, royalty, FTS without setting off of losses. You're getting my point? So if you are held to be head of poem in India, then it will in the favor of revenue only, in the favor of tax department only. You can set off your losses, but only against those income which were earlier not taxable and now has become taxable because you become a resident in India. So it says, loss and unabsorbed depreciation of the foreign company shall be allowed to be set off only against such income of foreign company which has become chargeable tax in India on account of it becoming resident in India due to poem. So only against those income which have become chargeable because the company become a resident in India. If this brought forward losses is subsequently revised or modified in the foreign jurisdiction, then the set off should also be modified. Now the most important part, what happens if the foreign company, the country in which the foreign company is situated, follows a year different from the financial year? So it says, if it follows a year different from the financial year, then we will prepare P&L account, the financial statement, up to the 31st March, and then for 12 months starting from April ending on March, assuming the company follows the calendar year. And the company is said to have a poem in India during the financial year 25-26. Then the company shall prepare P&L account for 1st April, 1st January, 1st January 25 to 31st March 25, and then for 1st April 25 to 31st March 26. This is a period of 12 months, this is a period of 3 months. So prepare account for 3 months, ending on 31st March. Assuming the company follows the accounting period as June to July. 1st July to 30th June. Okay. In this case, the company shall prepare its financial statements, income and expenditure P&L account for 1st July 24 to 31st March 25, and then from 1st April 25 to 31st March 26. So for 12 months, and this is for 9 months. So if your accounting is different from the financial year, then you prepare your account up to 31st March, whether it's a period of 6 months, 3 months, 9 months, whatever. And then you prepare account from 1st April to 31st March, 12 months. Okay. But in case of brought forward losses, it says if this period is less than 6 months, if the immediate preceding accounting year is less than, this is my accounting year in which I have been held to be QM in India, I have been held to be resident in India. If the immediate preceding period is less than 6 months, We're talking about this period. Here, this period. Here it is 3 months. If in case of July to June, it's 9 months. If the immediate preceding period is less than 6 months, then this period is combined with the preceding year. So in this case, the company shall prepare account for the 15 month. 1st Jan 24 to 31st March 25. Because this is for less than 6 months. But in this case, it will not combine it with the earlier accounting period because it's for 9 months. Okay, important thing. TDS. See, under TDS provision, there is section 195 which is applied on NR or foreign company. Meaning thereby, if any payment is made to NR or foreign company, then tax is to be deducted in section 195. If the recipient is NR or foreign company, then tax to be deducted under section 195. Yes, sir. Yes, sir. And there are some domestic TDS provisions, say 194J, C, all these provisions. They generally apply if the payment is made to a resident. Okay. Now see what happens in this case. In this case, the foreign company becomes a resident in India. And if some person makes a consult professional fee or some technical fee payment to this foreign company, then that person is confused whether I need to deduct TDS under section 195 or 194J. Why? Because 195 applies. Why? Because the SFC, the recipient, is still a foreign company. It's even though it has a poem in India, but it continues to be a foreign company. And somebody say 194J, why? Because foreign company has become resident in India. Then both the section become applicable, 195 as well as 194J. You understand why? Because 195 applies on foreign company and 194J applies on resident. Now my SSC is both. He is a foreign company plus resident. He's a resident foreign company. So in which section I will deduct a tax? The law says in this case you will deduct tax under section 195 with provisions of both. If there's a conflict between provision which is applicable to a foreign company and a resident, then we will apply the provision which is applicable to the foreign company and not resident. So if there are provisions which are applicable to foreign company, they shall be applicable in this case. If there are provisions which are only applicable to resident, they shall also be applicable in this case. If there are provisions which is applicable only to NR, these provisions are not applicable. So you understand, there can be three types of provision. Provision which are applicable to foreign companies, provision which are applicable to residents, provision which are applicable to non-residents. If any provision applicable to a foreign company shall apply in this case because the SSC remains a foreign company, though resident. Now the SSC has become a resident, therefore this type of provision shall also apply. But the provision which are only applicable to non-residents shall not apply. And one more thing, if there is a conflict between one and two, then the one shall prevail. If similar transaction is subject to provision which is applicable to foreign company and there is separate provision in respect to that transaction only, which is applicable to resident, then we will apply the provision which is applicable to the foreign company. The company which has become a resident because of poem shall be entitled to the foreign tax credit in respect of taxes paid outside India, including in its home country. So it says this notification shall not apply in respect of income which was even otherwise taxable in India without the poem. This we discussed. So any provision which is applicable to a foreign company shall continue to apply to it. Any provision which was applicable to non-resident shall not apply. And the provision specifically applicable to residents shall apply. But if there is a conflict between 1 and 3, then 1 shall prevail. This entity, though become a resident, but since it's continued to be foreign company, shall continue to be taxable at the rate of 35%. Okay. So this completes our residential status. So let's revise quickly. If the assessee is an individual, we have to see the two basic conditions. If he satisfies any one of the basic condition, he is resident. So first basic condition is, one of the basic condition is whether he is in India for 60 days or more during the relevant previous year. If answer is no, if his stay in India is less than 60 days, answer is yes, then he's NR. If your stay is less than 60 days, then all cases your NR. No, no, your stay was 60 days or more. Then we have to see whether your stay was more than or equal to 182 days. Answer is yes, you are R. No. No means your stay is more than 60 days, but less than 182 days. That's a then only we shall come here. Now you see whether you are an Indian citizen who left India during the previous year for employment or as a member of crew of Indian ship. If answer is yes, then since your stay is less than 182 days, you are NR. But if answer is no, then see whether you are Indian citizen or person of Indian origin who visit India during the previous year. Answer is yes. Then we will see your Indian income if it exceeds 15 lakh rupees. Answer is yes. Then we have to see whether your stay in that one previous year is 120 days or more, and for the 4 preceding year 365 days or more. If answer is yes, then you are by default RNOR. I don't need to see the additional condition. If answer is no, then you are NR. Okay. But once you become an R, I have to see whether you are ROR or RNOR. For ROR, you have to satisfy both the additional condition. You have to be resident in India in at least 2 out of 10 preceding year, and you have to be in India for 730 days or more during the last 7 years. If you satisfy both the condition, you are ROR, otherwise you are RNOR. Then there comes the concept of deemed residency. If you are Indian citizen, your Indian income exceeds 15 lakh rupees, you are not liable to tax in any other country, and you don't satisfy any of the basic condition, then you shall be deemed to be resident in India. And when you become a deemed resident, then you will always become a RNOR. We will not see the additional condition. Okay. The period of stay in India is not relevant for becoming deemed resident. In case of other entities, now for HUF, it says for all other entities, HUF firm, AOP, BOI, local authority, AJP, where the control and management is it wholly or partly in India? Even if it's partly in India, then the entity is resident. If it's wholly outside India, means even it's not even partly in India, then the entity is non-resident. But if you're HUF and you become resident, then I have to see the two conditions in respect of your Karta. What are two conditions? Whether Karta is resident in at least 2 out of 10 preceding year, and Karta was in India for 730 days or more in the last 7 years. If we satisfy both the conditions, then the HUF is ROR. If it does not satisfy any one of the conditions, then the HUF is RNOR. Okay. Now comes the company, the most important one. Whether the company is an Indian company, answer is yes. The question stops, you are resident. No, you are not an Indian company. Now I have to see whether your poem is situated in India. If answer is yes, then you are resident. If answer is no, then you are non-resident. So the moot question comes where the poem of a company is situated. Which company? The foreign company. So if it is in India, then the foreign company is resident in India, liable to pay tax on the global income in India. If the poem is outside India, then foreign company is non-resident. How we compute poem? We ask the two questions: whether the company is engaged in active business outside India or not, and where the majority of board meetings happen. If company is engaged in active business outside India and majority of board meeting happen outside India, then poem is outside India. Okay. But if the company is not engaged in active business outside India, then we ask again two questions. We identify the person who are actually taking key management commercial decision, and then we identify the location where the key management commercial decisions are actually being taken. Okay. So this completes our residential part of status of our NR chapter. Now we'll take a 5-minute break and then continue. Okay. Thank you. So we discussed the residential status. Now we'll discuss the scope of totaling. This we have been discussing, and you know this scope of totaling. For ROR, whether the income received in India or deemed to be received in India is taxable. Whether income accrue arise in India or deemed to accrue arise in India, taxable. Income accruing arising outside India from business controlled from India, taxable. Other income accruing arising outside India, taxable. So in a sense, for ROR, the global income is taxable. But for RNOR, now we'll see the NR. For NR, only the Indian part of the income which is received in India or which accrue arise in India is taxable. But income accruing arising outside India is not taxable. What is the difference between R and OR? For R and OR, similar to NR, the Indian income is taxable. What happens? The Indian income is taxable, and the income accruing arising outside India is also taxable, but only in respect of business control from India. Simple. We know this by heart. Now, a benefit is given to a non-resident seafarer who is receiving their income in their Indian bank account. So, if there is a non-resident seafarer who is receiving, who is rendering service outside India on foreign ship, but is receiving the salary in his Indian NRE account, that since the income is received in India, has become taxable, and therefore a benefit is given then to the non-resident seafarer that their income shall not be taxable if the service were rendered outside India, so the income does not accrue arise in India, and they are employed with the foreign ships. When we talk about receipt, we mean the first receipt, not the remitter. The first time when the income comes into control of the assessee. So if the first received is in USA and then the amount is remitted to India, then it's not taxable in India. We have to see where is first receipt. If the first received is in India, then the income is taxable in India, irrespective of the fact where it accrues. Not only the actual receipt, the income which is deemed to be received also taxable. Okay. Section 7 deals with the income which is deemed to be received in India. Okay. So it's in all these cases, not much relevant from exam point of view, though the income is not actually received, but is deemed to be received and therefore taxable. What is the case? If the contribution in recognized provident fund exceeds 12%, then you know then it's taxable and it is deemed to be received in India. If the interest on such contribution on the employee on the contribution in the on the balance standing in the employee's account in RPF exceed 9.5%, that the excess interest is deemed to be received in India. Contribution by the employer to the NPS scheme is deemed to be received in India. Is deemed to be received. Or any amount transferred from URPF to the RPF is deemed to be received. So this was small part. So what it says that the income which is received or deemed to be received, or the income which accrues in India or deemed to accrue in India, both these income are taxable irrespective of the residential status of the assessee. So these two income are taxable in every case, whether the assessee is resident or non-resident. So income which is received in India or deemed to be received in India, income accrue arise in India or income deemed to accrue arise in India. Okay. We understand the meaning of word received. We understand the meaning of word deemed to received. Section 7. We know accrue. What do you mean by accrue? Income accrues as a place where the activities in respect of such income to earn such income is actually performed. So where the income is generated, where activities are performed, is said to be place where the income is accrued. Now there is section 9, very much important section from your exam point of view. it defines, it lists down the income which is deemed to accrue or rise in India. So where the income accrues, where there is actual income, actual accrual of income, actual accrual is at a place where the activities to earn such income are actually performed. Okay. But now we will see section 9, which will list down some incomes which will be deemed to accrue or rise in India. We will not see where the activities are performed. The law says they are deemed to accrue or rise in India. They are deemed to accrue or rise in India, even if the activities are performed outside India. Okay, this is the meaning of deeming. So I'll study section 9 in respect of non-resident. Why? Because for residents, the global income is taxable. Whether income accrue or rise in India or accrue or rise outside India is not relevant. Section 9 is relevant only for non-resident. If the assessee is resident, that even if section 9 was not there, his global income is taxable. What does the section 9 does? Section 9 will do, it will make some income which we believe accrue rise outside India, but which it will make them deemed to accrue rise in India. For whom? Only for the non-resident. Because if the assessee is resident, then even the income accruing rising outside India is taxable. So with me. So I study section 9 by keeping the assessee as non-resident. It will help me to understand it better. Okay. So section 9, let's see 9.1.1. The first clause. Income accruing or rising outside India directly or indirectly through or from any business connection in India, any property or asset or source of income in India, transfer capital assets situated in India. We'll do one by one. So 9.1 say, if any income arise to assessee, whether directly or indirectly through or from any business connection in India. If any income arise through any business connection in India, then such income shall be deemed to accrue or arise in India. Now see what does it mean. If the non-resident, the foreign company, is actually doing business in India, then of course the income from such business is taxable in India. The income, because such income has actual accrual in India. Such income actually accrue or rise in India because business in India. So the foreign company is doing business in India, then whatever income it is deriving from such business taxable in India on the basis of actual accrual. Okay. Now what the foreign company does, it does not do a business itself. Rather, it hires an agent. And there's an agent who does all the activities which the foreign company should have done itself. Whether this would escape the foreign company from Indian taxation? Answer should be no. You only use a person instead of you to do the same activity. So if you were doing this activity, you were taxable. If somebody else is doing these activity on your behalf, then also you will be taxable. Because such person is doing everything on your behalf, it will be deemed that you are actually doing it. So this is business connection. Business connection is if the foreign company or the non-resident has an agent in India who actually doing some activities on behalf of such non-resident, then it will be deemed that the non-resident has a business connection in India. So the important part is, in case of business connection, if the entire business is not in India, what will happen? The agent, the person who is acting as an agent in India, he will be doing only a part of the activities of the business. The entire business will not be in India. So all the profit of this business or such business cannot be taxed in India. So what it says that income attributable to the operation carried out in India shall only be taxable. Okay, you have me? So if whole of the business is not in India, then only so much is the income as attributable to the operations of the business carried out in India shall be taxable in India. Very much logical. So now, what are all those activities which constitute a business connection of non-resident in India? So business connection shall include any business activity carried out through a person acting on behalf of non-resident. If any business activity is carried out by a person on behalf of non-resident, then such non-resident shall be deemed to have a business connection in India. You understand? It's not saying that non-resident is itself doing business in India. Why is it not saying that? Because in such case, there is no question of deeming. There is the actual accrual. Okay? It's in any case taxable. So now what are the activities which the agent has to do to qualify to make that non-resident having a business connection in India? So if the agent have an authority and such authority he habitually exercise as well. So one thing, he has an authority and he habitually means on a continuous basis. He habitually exercise such authority. And what is the authority? To conclude contract on behalf of non-resident. So the agent is actually concluding contracts, is signing the contract on behalf of non-resident. Then we deem that non-resident has a business connection in India, and the profit attributable to the operation of agent in India is taxable in India in the hands of non-resident. Or the agent does not have the authority to conclude contract, but he habitually conclude contract. The first point was he has the authority and he habitually exercises the authority to conclude contract. Second point is he does not have a formal authority, but he habitually conclude contract. Remember, in the first part we discussed about this. The first part is talking about regio, where the non-resident formally given an authority to conclude contract. The second part is called de facto. Though the non-resident has not given the formal authority to conclude contract, but habitually the agent as a conduct, he concludes contract on behalf of NR. Then this also would become business connection. Or neither he has that authority, nor he habitually conclude contract. But what he does, he habitually plays the principal role leading to the conclusion of the contract. In first two parts, the contract was concluded by the agent. But in the third part, contract is being concluded by the NR itself. But what the agent is doing, agent is playing a principal role in the leading to the conclusion of the contract. So he's playing the principal role, which leads to a conclusion of contract by the NR. Then also, this role which he's playing will result into constitution of P by the NR in India. Okay. Or the agent habitually maintains a stock of goods in India from which the goods are delivered. Or the agent habitually secure order in India mainly or wholly for the NR. So for securing order, he mainly or wholly working for the non-resident. In all these cases, the non-resident shall be said to have a business connection in India. And once a non-resident has a business connection in India, then profit attributable to this business connection, to the activities carried out in India, shall be taxable in India. Okay. So what are these points? One, he has authority to conclude contract, and he habitually exercises such authority. Which authority? To conclude contract. Or he has no such authority to conclude contract, but he habitually conclude contracts on behalf of NR. Or he neither has authority nor he conclude contract, but he plays principal role in conclusion of contract by the NR. So contract is concluded by the NR, but the agent in India, he plays principal role in conclusion of contract. Conclusion of contract. In any of this case, 1, 2, or three. In any of these cases, the non-resident shall be said to have a business connection in it. Or the agent maintains stock of goods from which the goods are delivered on behalf of non-resident, or he secures order on behalf of for the benefit of non-resident. But in this case, he should work wholly or mainly for such non-resident. This we call dependent agent. If an agent is working wholly or mainly for a non-resident, then it's called dependent agent, and he's securing order as a dependent agent, then only a business connection of non-resident is established. He is working as an independent agent and he is securing a contract, securing orders for a non-resident, but acting in an independent manner, not working wholly or mainly for one NR. Then the NR for which he is securing order shall not constitute the business connection. You with me? In case of securing order, we have to see whether the agent in India is dependent or independent. If the agent is working wholly and mainly for NR, then dependent, and it will result in constitution of business connection. If agent is not working only for one NR, mainly or wholly, then he is an independent agent, he is acting in an ordinary course of business, and business connection is not constituted for all those NR for whom he is working. Okay. But if he is a dependent agent for, say, NR1, and he also secures order for NR2, so he is dependent on NR1. Of course, NR1 has a business connection in India. Full stop, no problem. Yes, I understand. But assuming he also secures order for NR2, but not mainly or wholly. He mainly or wholly works for NR1. But he secures order for NR2, then NR2 can also be said to have business connection, but only in that case where NR2 is controlled by NR1 or NR2 controls NR1 or both NR1 and NR2 are under common control of some other NR. In this case, since the agent is dependent on NR1, NR1 has business connection, no problem, simple. And since NR2 is related to NR1, how? Either the NR2 is controlled by NR1, NR2 is controlling NR1, or both are under common control. In either of these cases, the NR2 will also be deemed to have business connection. But if the NR2 is independent of NR1, then the NR2 will not have a business connection because that agent is not securing order wholly or mainly for NR2. So you understand? So there are 3 points. The first point has to break into 3 parts. If the agent is in respect of conclusion of contract, first point. If the agent has authority and he habitually exercises such authority to conclude contract, 1, in this case, NR has a business connection in India. 2, agent does not have authority, but he habitually exercises the contract. He habitually concludes the contract. Then also, NR shall be deemed to have a business connection in India. Lastly, he does not even conclude contract. He has no such authority. He does not even conclude contract, but he plays principal role in which lead to the conclusion of contract by the NR. The contract is actually concluded by the NR, but he plays principal role. Then also NR is said to have a business connection in India. Or he habitually maintains stocks of goods from which the stock is delivered on behalf of a non-resident. Then the NR is said to have business connection. Now the third important part, he is called securing order. If the agent in India habitually secures order mainly or wholly for an NR, then such NR is said to have a business connection in India. But if the agent does not secure order mainly or wholly for NR, then the NR shall not be said to have business connection. But in such case, if the NR is related to the NR for which this agent is mainly a wholly securing order, then the other NR shall also be deemed to a business connection. And what is the relationship it requires? Either the NR1 is under the control of NR2, or NR2 is under the control of NR1, or both are under the common control. You understood? So it's that Mr. A is an agent in India. He is acting on behalf of Mr. X, a non-resident. He secures order for X, then Mr. X has a business connection. But he secures order for Y also, and so Y shall also be deemed to a business connection if X is controlled by Y, or Y is controlled by X, or both X and Y are controlled by Z. So either of these, only these three conditions, Y shall be deemed to have a business connection, otherwise not. So agent having independent status are not included in business connection if they are acting in their ordinary course of business and he does not work mainly wholly for the NR. If a business connection constituted, then only so much of the income as is attributable to the operation carried out in India shall be deemed to accrue or arise in India. You with me? Let's revise fast. We have done poem, yeah. Business connection. We revise it fast so that you understand. Why business connection exists? Foreigner earning income without presence. India wanted fair share of tax link between income and India requires. Understood? Business connection means there should be a real intimate relation, substance or form. Foreign company sells goods in India. Operation partly in India, income attributable to Indian operation taxable in India. So, for business connection, there should be business in India, not business with India. If you are selling goods from outside India and nothing is happening in India, then there is no business connection. For business connection, it should be business in India, not business with India. Here, no BC. Here, BC. Yeah. Business connection. Classic example business connection. See, if the non-resident has a branch or office in India or a factory or workshop or a sales outlet, in all these cases, there is actual accrual. So, no need of an agent. No need of business connection is the NR is actually doing business in India. It doesn't have a business connection, it is actually doing business in India. So, income attributable to these operations are taxable in India. But now the concept of agency comes. When you shift it to agency model, instead of you doing business yourself, you hire an agent who acts on your behalf. So a foreigner may not come to India personally, but may still do business in India through another person. That person is called an agent. So the law says, if NR carries on business in India through an agent, then an NR is treated to have a business connection. You cannot avoid tax only because now you're not doing yourself, you hire an agent. The law initially assumed business done personally or through office or branch. But therefore, business connection was not there. But why the need of business connection arises? Because business can be done through agent as well. But in reality, business often operates through representative, especially the foreign company. Once the law is evolved, if someone in India habitually acts for you, it is as good as you being here. So earlier you used to be in India and doing business in India, having a branch office in India, but now you hire an agent who is doing all this on your behalf. In both these cases, the income shall be taxable. Now, what are the activities by which the NR shall constitute a business connection in India? Instead of concluding contract. If a person in India habitually concludes contract or habitually negotiate and finalize the contract on behalf of non-resident, BC exists. Business connection exists. Agent who maintains stock or deliver goods also constitute a business connection. If your goods are waiting in India to be sold, your business is already in India. Agent who habitually secures order for non-resident. Secures order mainly or wholly for the non-resident. Business connection exists. But only dependent agent creates business connection. Dependence means he works mainly or exclusively for the non-resident. Independent agent does not create business connection. An agent is independent if he works for multiple principal, has own business setup, be as entrepreneur is legally and economically independent. Independent agent does not create business connection. You understand how this law is evolved? So earlier, the NR used to do the business himself and was liable to Indian tax. Now, instead of coming to India himself, he appoints an agent and gives him an authority to conclude contract. The law says if the agent has authority and he exercises such authority, then the NR shall be deemed to have business connection, therefore taxable. Now, what he said, I have not given the authority. But even in this case, if agent habitually concludes contract, then also business connection. If the agent does not even conclude contract, now agent is only playing the principal role, then also the business connection. The need to widen the definition arises because the people keep on changing their how they do their business. So keep on evolving new system by which they can escape tax. Therefore, tax law has to also evolve themselves. Okay. Now, one more thing. Till now, we studied with the view that business is done physically, either by the NR or by through his agent. But in reality, now in today's world, even the business is done digitally, virtually. So now the foreign company or resident neither requires to himself come into India, nor he actually requires any agent in India. He can be outside India, sit in his own country, and still have a business in India because this internet has the digital world has given this flexibility. Now, in such case, since he is not even coming to India, nor he has any agent in India who is acting on his behalf, how will the Indian law tax the foreign company? But the fact is that the foreign company is driving revenue from India. So why? How come? Because there is a website of foreign company from which it is selling goods in India. It happens. There is a foreign company has developed a game and which is subscribed by the Indian users. Foreign company has a database which is subscribed, which is sold by to the Indian user. Foreign company is giving is showing advertisement to the Indian people, but everything is been done from outside India. There's a data collected from the Indian people. This data, the foreign company is selling the data and earning income. You know, the whole transaction of sale of data is happen outside India. The buyer outside India, the seller outside India, the quantifier enter outside India, money received outside India. Nothing happens in India. How can India can tax? But if you think these all things should be taxable in India and India is losing its tax revenue. So therefore, since the businesses have evolved, the concept of significant economic presence came. What it says that even if the NR has a SEP, significant economic presence, it will be said to have a business connection in India. The definition of business connection is expanded. Now, what do you mean by SEP, significant economic presence? It means any transaction in respect of goods, service, or property carried out by non-resident with any person in India, including provision of download of data or software in India. If the aggregate of payment arising to such non-resident exceed rupees 2 crore. Okay. If the foreign company has some data and it's charging rupees from the people to download such data, and such data has been downloaded by the people in India, and the amount which the foreign company had received from the Indian people against this download is exceed rupees 2 crore, then in this case, the foreign company shall be deemed to have a business connection in India, even though neither the foreign company nor any agent is doing anything on the Indian soil in India on behalf of the foreign company. You understood? Assuming there is a mobile app and a mobile game which requires payment for download. It's worldwide. It is being developed by the China. Now the Indian people downloads it and makes the payment through their Paytm or whatever, and the Chinese company is driving revenue, and the revenue derived from India, if the in a year exceed rupees 2 crore, then the Chinese company shall be deemed to have business connection in India, and a part of this revenue shall be attributable to Indian operation, and this Chinese company shall be liable to pay tax in India. Okay. Why the need of SCP arises? Because now the business can be done digitally without having any agent in India. Okay. SCP also includes transaction which requires systematic and continuous forwarding of business activity or engaging in interaction with users. So even if you have a users in India and the number of users is 3 lakh or more, then it will be deemed that you have a business connection in India. Now see, it's not necessary that you must be driving revenue from India. In YouTube, if there are views, then there's a revenue. And if those views are coming from India, then the company shall be deemed to have a business connection in India. Okay. Provided the user are 3 lakh or more. Should be at least 3 lakh. Understood? So the two types of transaction which constitute a significant economic presence, meaning they shall constitute business connection even if no activity is being carried out by agent on behalf of the non-resident in India. What? One, if there is some transaction in respect of goods or service and the payment which is received from India aggregates to rupees more than 2 crore, or if there is an engagement of user and a user in India is 3 lakh or more. In either of these cases, the non-resident shall be deemed to have business connection in India. In these cases also, the income which are only attributed to operation carried out in India shall be taxable. So that's clear. Now, in these three cases, it shall be deemed that there is a business connection in India, operation carried out in India. What? Income from advertisement targeting customer residing in India or assessing advertisement through IP address located in India. If there is a foreign company, advertisement company which gives order advertisement, which makes advertisement, which earns from advertisement revenue, is showing advertisement to Indian customers, to Indian people, then the revenue is deriving from this advertisement, it received from the person who is showing the advertisement shall be deemed to be income attributable to operation carried out in India. Or if the foreign company derive revenue from sale of data, which was collected from person residing in India, then also this income shall be deemed to be income attributable to operation carried out in India. Or the NI is deriving income from sale of good using such data, then the income which the NI is deriving from sale of good shall also be taxable in India. So what it says that, assuming there is a foreign company, Facebook, which shows advertisement, okay, and if it shows advertisement to Indian customers, So this Facebook is US, and another US company gives a contract to Facebook to run its advertisement on its website, and the advertisement shall be for the Indian customers. Then the revenue which the US is Facebook US is driving from another US company in the US shall be taxable in India. If there is a company A, INC in US, a foreign company, it collects data from India and it sold this data to B Inc., another US company. Then the income from this sale is taxable in India because data is for Indian people. Not only this, now B Inc. uses this data to sell goods. Then wherever the goods are being sold, whether in India or outside India, the goods are being sold using this data, then the income which the B Inc. derive from selling the goods shall also be taxable in India. So, you understood? Now, there are some activities which are specifically excluded from the definition of business connection. So business connection includes any activity being done in India on behalf of another. You understood by now? But there are some activities which the government wants to encourage, and therefore these activities are excluded from the definition of business connection. If you're purchasing goods in India only for the purpose of export, so your activity is confined to purchase of goods, you're not doing anything else, you're merely purchasing goods only for the purpose of export. This activity of purchase of goods shall not create your business connection in India. If your activity are confined to collection of news and views in India for transmission out of India, okay. So this is if you are a broadcasting company, news agency, news company, then you're collecting news from India for telecasting outside India. It's something similar to purchase of goods in India, and for you, the news are raw material only. If you're shooting any cinematographic film in India, then also the merely shooting of cinematographic film is not create a business connection. But if the assessee in this case, the one who is shooting the film, is individual, then he has to be non-resident plus not a citizen of India. If the assessee is a firm, then none of its partners should be citizen or resident in India. If assessee a company, then none of its shareholders should be a resident or a citizen of India. Lastly, activity of the foreign company which is engaged in mining of diamond outside India. What does it do? In India, it only display the rough diamond, the unassorted or uncut diamond, and that too in a specified notified zone by the central government. The activity of this display shall not result in creation of business connection of this foreign company. So point E is applicable only for the foreign companies, but other 3 points applicable to all assets. Okay, so this completes our business connection. Now, any income which arises from any property in India shall also be deemed to accrue or arise in India, or from any asset in India shall be deemed to accrue or arise in India, or from any source of income in India shall be deemed to accrue or arise in India. Okay. If you have a immovable property, land, building, house in India, you means a non-resident, and the non-resident given this land on a rent. So the rent which he is driving shall be taxable in India, shall be deemed to accrue or rise in India because the property is situated in India. If the non-resident has made an FD with the Indian bank in the SBI Delhi, then the interest which is driving from the SBI Delhi from this deposit shall be taxable in India, shall be deemed to accrue or rise in India. Now, income through transfer of capital assets situated in India. So, through transfer of, so from transfer of capital asset, what we derive? We derive capital gain. So, we are talking about capital gain here. So, the income from transfer of capital asset is called capital gain. So, capital gain are taxable in India if the capital asset is situated in India. Okay. In case of share or debenture, they are situated at a place where the company for the share, say if the shares of Reliance, so share of Reliance situated in a country where the Reliance is incorporated. So since Reliance is incorporated in India, the share of Reliance is situated in India. So wherever the shares of Reliance is transferred, the income is taxable in India. Even a non-resident sells the share of a Reliance to another non-resident. The profit it derives, the capital gain it derives shall be taxable in India because the capital asset is situated in India. So for a capital gain to be taxable, the capital asset must be situated in India. Okay. So only condition is the capital is situated in India. So other factors like the place of registration, not relevant. The place of payment of consideration, not relevant. The only thing that is relevant is where the capital asset is situated. Is capital asset situated in India? Then the capital gains of derived by non-resident shall be taxable in India. Okay. Now here comes the Vodafone part. So if you remember, there was a case in respect of Vodafone. So what happened is that before Vodafone there was Hutch. There was Hutch India. It was a wholly owned subsidiary of the Hutch Cayman Island. Above it, the ultimate holding was Hutch UK. Now, Hutch wants to sell the Hutch India company. Now, instead of selling the Hutch India company, what it sold the shares of Hutch Cayman Islands to Vodafone. Now, the shares of Hutch Cayman Islands is a capital asset which has been transferred by the Hutch UK to Vodafone. So he is the seller and the Vodafone is the buyer. And the asset which is transferred is the shares of Hutch Cayman Island. Where these shares are capital assets situated in India? Of course, the answer is no. They are situated in Cayman Island. They are not the shares of an Indian company. Had the Cayman Island company had sold the shares of Hutch India to Vodafone, then this is the shares of Vodafone Hutch India was a capital asset situated in India. But now what has been transferred is not capital asset situated in India, and therefore whatever gain derived by Hutch UK is not taxable in India. You with me? This was held by the Supreme Court as well. But government did not like this. So what the government did is, government amended the provisions. It says that the broad principle is same. The capital gain is taxable only if the capital asset is situated in India. Okay. But now government gives a definition, explanation 5, where it says that in case of a share of a foreign company, they shall be deemed to be situated in India if they derive their value, if they derive their substantial value from assets in India. What it says, if the share of a foreign company shall be deemed to be situated in India, otherwise share of foreign company is situated in a foreign country. But we will deem it to be situated in India when they derive their substantial value from the asset located in India. So in case of Hutch Cayman Island, if the value of the shares of Hutch Cayman Island is substantially derived from the shares of Hutch India, then it shall be deemed that these shares are situated in India, and since they are situated in India, the capital gain arising to Hutch UK shall be taxable in India on sale of these shares. You with me? So this was the precise amendment to overrule the Supreme Court decision in case of Vodafone. Why this amendment was made? Because the government realized that you are actually transferring the share of a foreign company, but you meant to transfer a share of an Indian company. Because what the Hutch wants to transfer, what the Vodafone wants to buy, they don't have any interest in the Cayman Island company. Because the business actually lies here. They have only interest in the Indian company. So what they want to buy, what they want to sell, what the Hutch wants to sell and what the Vodafone wants to buy is the control and management of Indian company. Now, if Hutch had transferred the Indian company directly, it would have resulted in payment of capital gain tax. So they planned. What they did, they transferred the holding company of the Indian company. And if the Vodafone acquired the holding company, they will get the control and management. So what the logic behind this is, if you transfer the shares of holding company, a company which is holding company of an Indian company, so though you transfer shares of a holding company which is situated outside India, but you transfer the control and management of the Indian company and therefore should be taxable. This is the thought behind this. And how they say it? They say it by saying if the shares of the holding company is driving value from asset in India, substantial value, means more than 50%, they shall be deemed to be situated in India. Now you understood? So what does the explanation 5 says? Capital asset being share in a company registered outside India. Which capital asset we are talking about? The share of foreign company. They shall be deemed to have situated in India if they derive a substantial value from the asset located in India. However, it does not apply to capital asset being the investment in category 1 or category 2 FPI. Also, though the shares have been held, share of foreign company are deemed to be situated in India, but if they pay some dividend, then such dividend shall not be taxable. So this deeming fiction is only in respect of capital gain. So when the shares are said to have a substantial value deriving from asset in India, if the Indian asset exceed rupees 10 crore and they represent at least 50% of total asset of the entity. So if in case of Cayman Island, if you draw the balance sheet of Cayman Island, if there is an Indian asset and there is foreign asset, so there is total. So there is 20 and there is 10. The total is 30. So since more than 50% of the assets are Indian asset, then the shares of this Cayman Island company shall be deemed to be situated in India, provided these Indian assets are more than 10 crore. We have to do this calculation when on the end of the accounting year, immediately preceding date of transfer. However, if the book value of the asset on the last day of the accounting period and on the date of transfer, the book value of the asset on the date of transfer exceeds 15% of the book value of the asset on the last day of the accounting period, then we will do this exercise on the date of transfer. It says that even if this condition satisfies, the shares of foreign company has been transferred, the shares of foreign company are deriving value substantially from Indian asset, still there will not be any capital gain if in case a direct foreign company has been transferred. Meaning there's a foreign company which holds an Indian company. If shares of this foreign company has been transferred, it will not result in Indian taxation in the hands of seller if the seller, S does not have any control and management in this foreign company, or S does not have more than 5% of share in this foreign company. Okay, so the shares of foreign company are deemed to be situated in India, but still no capital gain shall be taxable on transfer of this share if the seller does not have control and management of this foreign company, nor he has shares exceeding 5% voting power in this foreign company. And secondly, so this FC1, it controls FC2, and this FC2 controls Indian company. Now shares of FC1 are being transferred. So indirectly, one step above the holding of the immediate holding of the Indian company. This shares, though they derive their value substantially from the Indian asset, still the transfer of this share shall not be taxable in the hand of seller. If by holding the shares in FC1, the seller does not have any control on management, does not hold any control in the management of FC2, neither by holding shares in FC1, he does not hold the shares more than 5% voting power in FC2. Understood? In these cases, the capital gain derived by seller from transferring the shares of foreign company, which though derive their substantial value from Indian asset, shall not be taxable in India. The moot point is the seller should not have control on management of the immediate foreign company, immediate holding company of Indian company, nor it should have more than 5% voting power in such immediate holding company. Assuming in case of Cayman Island, I told you the Indian shares have a value, Indian asset have value of 20 crore and the foreign asset have 10 crore. Now the shares of this company has been transferred. Now this transfer shall be taxable in India, because these shares are deemed to be situated in India. Now the entire capital gain will be taxable. Answer is no, because they have foreign asset as well. So only the capital gain attributable to Indian assets shall be taxable in India. Okay. Now, income from salaries. What it says? Salaries shall deem to accrue or rise at a place where the services are rendered. So, salary includes the immediate remuneration, also the deferred remuneration. So, if any pension is given, pension shall be deemed to accrue or rise a place where the services from where this pension arises were rendered. So if now the services are being rendered in India, and after retirement, the person shifts to Thailand and he receives a pension in Thailand, such pension shall be taxable in India because it's deemed to accrue or rise in India because the pension accrues where the main service were rendered. Okay. If you are an Indian citizen, government employee, then the salary received by you shall be deemed to accrue or rise in India, even if services are rendered outside India. This is exception. This is actually a deeming fiction. So even if services are rendered outside India, it should be taxable in the hands of Indian citizen if the services are rendered to the government of India. But in this case, the precautionary and allowances are exempt under section 10(7). This exemption is available under both the regime, old and new. Dividend, where the dividend is deemed to accrue. Dividend deemed to accrue arise in India if it is paid by the Indian companies. Now the interest, not important part, interesting part. The interest is accrued if it is paid in India, interest accrued in India, deemed to accrue in India, if it is payable by the government of India. So if the loan is taken by the government and government is paying the interest, then such interest is deemed to accrue rise in India. If it is payable by the resident in India, except where the money borrowed by the resident is used for business profession outside India or for earning any income from any source outside India. If it is payable by the non-resident, means there is a non-resident, say Trump, he borrowed some money from Putin. So he's paying interest to Putin. Both are non-resident. This interest shall be taxable in the hands of Putin in India if the amount so borrowed by Trump is invested in the Indian business of Trump. If Trump has some Indian business and he has invested this amount, which he borrowed from another non-resident in Indian business, then the interest so paid by him shall be deemed to accrue or rise in India in the hands of recipient. There is one explanation that in case of foreign banks, they have branches, say Standard Chartered Bank, they have branches in India. These branches qualify as a P. They're doing business in India. When these branches pay interest to foreign banks, it's deemed as a transaction between two separate persons, and the interest so derived by this foreign bank shall be taxable in India. And such interest, of course, allowed as deduction in the hands of Indian branch. Indian branch is required to withhold tax as well. Okay. Now, let's understand we discuss which income is taxable when the interest or dividend is taxable. Now we'll discuss at what rate they are taxable. So a concession is provided under section 115A. X109. So we quickly move to 109. Yes, there. There is section 115A, which says that dividends are generally taxable at the rate of 20% in the hands of NR or foreign company. But if dividends paid by a unit in IFSC, then they are taxable at the rate of 10% concessional rate. For interest, it says again 20% rate if interest is paid by the government or an Indian concern, then taxable at 20%. So remember, if interest is received from the government or Indian concern, then the tax is 20%. But here, if the Trump has taken a loan from Putin and he has invested the amount in his Indian business and paying the interest to Putin, then this interest which the Putin is driving is not from the government or the Indian concern. Then the concession rate of 20% of section 115A is not applicable in the hands of Putin. So the tax rate given in section 115A is 20% for the interest received from government or Indian concern. But interest is received from an infrastructure debt fund, then the rate is only 5%. Also, if interest is received under loan agreement, which was entered between 1st July 12 to 30th June 2023, and then such interest taxable at the 5%. So if the loan agreement was entered into between 1st July 2012 to 30th June 2023, in this 11-year period, then such interest shall be taxable at the 5%. If such interest arising from the long-term infrastructure bond issued during this period, then also 5%. If such interest is arising from issue of long-term bonds issued from 1st October 2014 to 30th June 2023, then also 5%. If interest is deriving from the issue of RDB, rupee denominated bond or masala bond, on or before 30th June 2023, then also 5%. However, if the long-term bonds or rupee denominated bonds were issued by a unit in IFSC or they are listed in a recognized stock exchange IFSC, then the interest is taxable at the 4%. If they were issued after 30th June 2023, then the interest taxable at 9%. See, there are a lot of things. I have prepared a chart for you. It's very simple. So general rate is if interest is received from the government of India or any Indian concern, 20%. Now the concessional rate of 5% comes. When the interest is received from infrastructure debt fund. Okay, so these funds borrow the money for investing in the infrastructure in India. So if non-resident is receiving interest from infrastructure debt fund, then such interest taxable only at the rate of 5%. A non-resident receiving interest from any Indian concern or business trust, where if the loan was given between the period 1st July 12 to 30th June 23, Then also this interest taxable at the 5%. If loan agreement was entered into this period or long-term infrastructure bonds were issued during this period, then also the interest is taxable at the 5%. However, if interest is arising from issue of long-term bonds, and if the bonds were issued between 1st October 14 to 30th June 26, the outer date is same. Then also the 5%. If the loan agreement was between this period, 1st July 12 to 30th June 23, 5%, or the long-term infrastructure bonds, or the long-term bonds were issued between period starting from 1st October 2014 to 30th June 23, 5%. Or any RDB, liquid derivative bond were issued up to 30th June 23, then 5%. Clear? So, if the loan agreement or long-term infrastructure bonds or long-term bond or liquid derivative bond were issued up to 30th June 23, in all these cases, the interest shall be taxable in the hands of NR at the rate of 5%. Okay. But if these long-term bonds or RDB, which were issued up to 30th June 23, they are listed on a National Stock Exchange in IFSC. Then instead of 5%, the interest shall be taxable at 4%. But if they were issued after 30th June, means on or after 1st July 23, the concession is not available. But if they are listed in the recognized stock exchange in IFSC, then they are taxable at 9%. If they are not listed, then suppose 20%. Your concession was given only in respect of bond issued up to 30th June. Okay. And lastly, if the interest distributed by a business trust which is derived from SPV, then such interest also taxable at 5%. So you understood? Dividend taxable if it's paid by the Indian company at the rate of 20%. But if it's paid by a unit in IFSC, then dividend taxable at the rate of 10%. Interest is taxable in India, is deemed to accrue or rise in India if it's payable by the government or Indian resident, except if the money borrowed is used in the business profession outside India or carrying on business or earning an income from any source outside India. Or interest is payable by a non-resident if the money borrowed is used in business in India or okay. Such interest taxable if received from the government or the Indian concern at the 20%. If it is received under loan agreement or long-term infrastructure bonds or long-term bonds or RDB issued up to 30th June 2023, 5%. If interest received from infrastructure debt fund, 5%. If interest received from the issue of long-term bond or rupee-denominated bond issued up to 30th June 2023 and listed in recognized stock exchange in IFSC, 5%. If interest is received from issue of long-term bond or rupee-denominated bond issued after 30th June 23 and listed in recognized stock exchange in IFSC, then 9%. And lastly, if interest is received from a business trust which in turn has received the interest from SPV, then also 5%. Okay. So if you revise it one or twice time, it will be in your mind. Let's move back to our chapter, section 9. Now we'll go to the royalty. So royalty is taxable similar to the interest if it is received from the government or a resident person, except where the right property information from in respect of the royalty received is used by the resident person for business or profession outside India or for earning any income from any source outside India. It shall be deemed to accrue as in India if it is received from the non-resident. So NR receiving from NR. provided the NR, the payer, has used the right property information in his business profession outside in India or earning any income from any source in India. See this part, only this part is in addition in case of royalty, it was not there in interest. So if NR is receiving interest from another NR, it shall be taxable in India only if the payer has used the money borrowed in Indian business. If the payer has used the money borrowed for any income from any source in India, then this interest is not taxable in the hands of recipient. But in case of royalty, if an NR is receiving royalty from another NR, then also deemed to accrue rise in India if the payer of royalty has used the right property information in his Indian business or the payer has used the right property information for earning any income from any source in India. Okay. Now it says that if the Indian residents are paying lump sum payment for purchasing computer software along with hardware, then though the computer software are purchased, this lump sum amount shall not be deemed to accrue or rise in India. What do you mean by royalty? Royalty means includes any consideration, but that consideration should not be taxable under that capital gain for transfer of all or any right in respect of patent, invention, model, design, secret, formula, or process, or trademark. So if you transfer any right in respect of your patent, trademark, if you impart any information about the working of this patent, invention, model, design, if you give this patent, invention, model, design for the use and you charge something, if you give any information concerning technical, industrial, commercial, or scientific knowledge, skill, or experience, if you give for use or right to use any industrial, commercial, scientific equipment, or if you transfer all or any right in respect of copyright, literary, artistic, scientific work, including films or videotape for use in connection with television or in connection with radio broadcasting, or you render any service in connection with it. So actually, royalty arises for transfer of use or right to use of intellectual property rights, intangible assets. However, definition of copyright, definition of royalty was expanded to say that it shall include any consideration given for use or right to use of computer software per se. Even if the use of computer software does not come in any of the above definition, still it says that it shall be deemed as a royalty. So purchase of computer software shall be deemed as a royalty payment. Now, since it's qualified royalty, and you know that on royalty payment, TDS is deducted in section 194J. If you purchase you make the payment to the resident, or 195, if you make the payment to non-resident. So now purchase of computer software, tax has to be deducted. If the seller is resident, then 194J. If the seller is NR, then 195. But it gives a benefit, a CBDT has given a benefit. It says that if the seller, this seller one, which has sold the computer software to seller 2, and seller 2 has sold the software as it is without making any modification to buyer, and seller 2 has deducted tax of seller 1 under section 195, then buyer is not required to deduct tax of seller 2 if seller 2 gives a declaration to the buyer that I have not made any modification, I have deducted the TDS of the person from whom I have purchased under section 195, and here is my PAN. So if he gives a declaration to this effect, then the buyer is not required to deduct TDS of seller 2. See, the definition of royalty has been expanded under the Act to include any consideration for transfer of computer software. But in case of non-resident, the taxability arises under the Act or the treaty, whichever is beneficial. But under the treaty, there is no change in definition. The treaty even now says that royalty shall arise only the transfer of a copyright. But when I say we sell copy, when we sell computer software, we sell copyrighted article. Okay. So there's an important case by the Supreme Court in the case of Engineering Analysis Center for Excellence. Supreme Court said that though the computer software has been sold, which qualifies a royalty under the domestic law, but since the copyright article, there is no transfer of any right in respect of copyright. This transaction shall not be treated as royalty under the treaty, because under treaty, only transfer of copyright is treated as royalty. And therefore, Supreme Court said that if the assessee is governed by the treaty, then the consideration it is received from sale of computer software shall not qualify as royalty and therefore shall not be taxable in India. Also, one more thing, the definition also says that royalty shall include consideration for transfer of any right property information, whether or not the possession or control of such right is with the payer, whether or not such right is used directly by the payer, whether or not the location of such right is in India or not. So, irrespective of these three factors, the consideration of right property information shall be treated as royalty. Now, lastly, the FTS. Not last topic of the class, but last point of the, almost the second last point of the section 9. So similar to royalty, FTS is taxable if it is payable by the government or a resident person, except if the resident is using the services in its business outside India or for earning any income from any source outside India. This FTS is taxable in India if it is payable by the non-resident. If the non-resident is using this technical service in its Indian business or for earning any income from any source in India. FTS means any managerial, technical, consultancy services, but it does not include consideration for any construction, assembly, mining, or like project. See, this interest, royalty, and FTS are called source-based taxation. Why? Because they are taxable even in the case the non-resident does not have a business connection or permanent establishment in India, even if they were rendered from outside India. They are not rendered in India. Therefore, demification. If the services are actually rendered in India, then they have actual accrual. But interest, royalty, FTS are taxable if they are utilized in India. You understood? They are taxable if the payer has utilized the service in India. Though the service may be rendered outside India, not relevant. If they are utilized in India, then they are taxable. This is called source-based rule. Now we have seen the tax rates for dividend and interest. Now for royalty and FTS. So we have to see whether the recipient has a permanent establishment in India or not. If it has a permanent establishment in India, then whether this royalty and FTS are effectively connected to such permanent establishment. If answer of both these questions are yes, then royalty and FTS taxable on net basis under the head PGBP. This is given in section number 44DA. So what section 44DA says? It says, if royalty or FTS, if the assessee carries on business profession in India through PE, and such right property or contract is effectively connected to such PE, then the royalty or FTS shall be taxable under that PGBP on net basis after allowing all expenses. Only these two expenses shall not be allowed. One, expenses which are not wholly and exclusively incurred to earn such income. And secondly, amount paid by the PE to its HO, except the amount of reimbursement. In this case, the non-resident is mandatorily required to maintain books of account and get them audited. However, if the royalty and FTS are not effectively connected to the PE or the non-resident doesn't have a PE, then they are taxable under section 115A at the rate of 20%. page number 109. Yes. So it says, if the royalty FTA is received from the government or from Indian concern under an agreement which is approved by the government or which is in accordance with the industrial policy, then this royalty FTA is taxable at 20%. My 115A gives the tax rate for dividend, interest, royalty, and FTS. Okay. It says, in respect of all this income, there shall not be allowed any deduction under section 115A. If this income are taxable under section 115A, they shall be taxed on gross basis. In respect of interest and dividend, even the deduction under chapter 6A shall not be allowed. And the recipient is not required to furnish return of income if he is deriving only the income in the nature which is taxable under section 115A, interest, dividend, royalty, FTS, and the tax has been deducted on such income at the rate provided in section 115A. So if the payer has deducted tax at the rate provided in section 115A and the recipient has no other income, then the recipient is exempted from the requirement of filing return of income. However, if payer has deducted tax at a lower rate, because such lower rate is prescribed in the Municipal Taxation Avoidance Agreement, then this exemption from return filing requirement is not available. Okay. So this completes our section number 9, which is deemed to accrue rise in India from business connection, from any property or asset or source of income situated in India, any income from transfer of capital assets situated in India, then salaries, they are taxable if the services are rendered in India, or if you are a government employee and Indian citizen, then say deemed to accrue rise in India if for services rendered outside India as well. However, in such case, allowances and perquisite are exempt. Okay. Dividends are deemed to accrue rise in India if they are paid by the Indian company. Then interest, royalty, FTS. They are deemed to accrue rise in India if they are payable by the government, the Indian resident, except where the main asset, the money borrowed or the IPR, all the services are utilized for business profession outside India or for earning any income from any source outside India. This interest, royalty, FTS taxable in India if payable by the non-resident if the non-resident has used the money borrowed or IPR or the services in its Indian business, or the non-resident has used not the money borrowed. So interest is an exception. Non-resident has used the right property information, the IPR or the services, the technical service for earning any income from any source in India. Okay. The dividend is taxable under section 115 at 20%. However, dividends paid by the unit of IFSC then taxable at 10%. Interest received from government or Indian concern taxable at 20%. Interest received from infrastructure debt fund taxable at 5%. Interest received from Indian company or Indian concern or business trust under loan agreement or long-term bond or long-term infrastructure bond or rupee denominated bond issued up to 30th June 2023, 5%. If long-term bond or rupee denominated bond issued up to 2023 are listed on economic stock exchange in IFSC, then 4%. If long-term bond or rupee denominated bond issued after 30th June 23 but listed on economic stock exchange in IFSC, then 9%. Any interest paid by the business trust which it has received from SPV, 5%. Royalty FTS, if effectively connected to the PE in India, then net basis, books of account mandatory and audit mandatory. If there is no PE or this royalty FTS is not effectively connected to PE, then gross basis under section 115A at 20%. Under section 115A, no deduction shall be allowed. All this income, dividend, interest, royalty, FTS taxable on gross basis. No deduction chapter 6 allowed in respect of interest and dividend. Chapter 6 allowed in respect of royalty FTS. The recipient is not required to furnish return of income if it has only income referred to in 115A and tax has been deducted at the rate prescribed under section 115A. Okay. So this completes section 9 and 115A. Now, since we have time, 10 minutes, we may very quickly cover small topics, the presumptive taxation for NR and the capital gain. So, 84. So, you have written the page number. Yes, my friends, we have written the page number. So, it does not waste your time to search. 84. So, in case of non-resident, they presumptive. Some businesses which are given the option or which are mandatory, either or okay. In some cases, there's an option, so in some cases, it's mandatory that they can offer their income on presumptive basis. So, this is the income rate, not the tax rate. So, if the non-resident engage in business of shipping, then they can show the income, presumptive income at the rate of 7.5%. 7.5% of any carriage, any freight in respect of goods or passenger port from India, or 7.5% of the amount received in India in respect of goods or passenger boarded from any port outside India. So if the goods or passenger were boarded from any ships in India, then whether the freight is received in India or outside India, it shall be included because the accrued income accrued in India, it is received in India. If the goods of passenger were shipped from any port outside India, then if the freight in respect of such goods is received in India, then taxable. Or in respect of goods or passenger shipped from any port in India, then the freight in respect of such goods or freight passenger shall be taxable wherever they are received on accrual basis. And 7.5% of this sum shall be deemed to be the income. No option to show lower income. Section 44B. But if the NR is engaged in occasional shipping, then Section 172 applies. It's a complete code. It also gives 7.5% presumptive rate, but it apply only in respect of goods or passengers shipped from India. It says, Section 44B of 172, no deduction is allowed. It's taxable on gross basis. However, for 172, even the setup of brought forward is not allowed, and Chapter 6 deduction are not allowed. Both these two things are allowed in Section 44B. 172 says that the return of income has to be furnished by the master of the ship before the departure of the ship, and they pay the tax at the rate applicable to the foreign company. Even if the assessee is an NR individual, still under Section 172, the foreign company tax rate shall apply. However, the AO may exempt the requirement to furnish return of income before departure, where it feels that is not possible, and the master of the ship has made satisfactory arrangement for filing the return and payment of tax. The AO in such case has to pass the assessment order, mandatory assessment order, within 9 months from the end of the month in which the return was filed. And the assessee has an option to opt for 44B before the end of the assessment year. And why will assessee will opt for 44B? Because under 44B, there are three benefits. One, the tax rate, if there is an assessee individual, then under 44B is taxable on the tax rate applicable to him. But under Section 172 is taxable on the tax rate applicable to the foreign company. Then a 44B, you can set off your brought forward losses. Then a 44B, you can claim Chapter 6 deduction. All these three things are not there in Section 172. Okay. Now 44BB, assessee NR engaged in business exploration of mineral oil. So any receipt received on account of providing services or facility in connection with supplying plant or machinery on hire, used or to be used in the prospective extraction of production mineral oil in India. There are 10% presumptive rate is prescribed. However, in this case, assessee can opt for the lower income. However, say in year one, assessee opt for the lower income, in this, once successfully opts for the lower income, he has to maintain the books of account, get them audited. And in the books of account, he show the loss. Now in year 2, he wants to opt for the presumptive taxation at the rate of 10%. But now in year 2, when he's going for presumptive taxation, he cannot settle this loss. He has to pay tax on 10% income. Okay. 44BA, assessee engaged in the operation of aircraft. The presumptive income is 5%. And on what amount? Similar to the shipping. On any goods or passenger who boarded from any place in India, or any freight received anywhere in the world, received in India, in respect of goods or passenger boarded from any place outside India. Similar, very simple sections. If the NR foreign company is engaged in the civil construction in respect of certain turnkey power project, then the presumptive rate is 10%. Option to claim lower income if you get the books of maintain the books of account and get them audited. And similar, you cannot set off your brought forward losses against the presumptive income. Recent changes: non-resident engaged in the business of cruise ship, then the presumptive rate is 20%. And if this is the foreign company which is operating a cruise ship in India, he has to offer income at the 20%. But if it pays rent for the ship to its fellow subsidiary, then such rent for the ship is not taxable in the hands of fellow subsidiary. Lastly, the non-resident engaged in the business of providing services or technology for setting up an electronic manufacturing facility or in connection with manufacturing or production of electronic goods in India, then the higher rate of 25% is prescribed. This percentage is the income percentage. You apply this percentage on the revenue, and the amount you derive is the PGBP. So this was all in respect of presumptive taxation. Now let's discuss the capital gain aspect in respect of non-resident as well. Only two provisions, very small provision. I'll discuss this without the notes. So I have marked in the notes as well, but no worries. If a non-resident transfer any shares or debenture of Indian companies, then here the capital gain is computed under first proviso, and first proviso says that the sale consideration, the cost of acquisition, and transfer expenses shall be converted into the foreign currency which was utilized to purchase the share or debenture, and the capital gain so derived shall be reconverted into the Indian currency. Okay, and we will use for converting a sale consideration, we use the average TTB and TTSR rate as on the date of transfer. For cost of acquisition, we use the rate as on the date of acquisition. For transfer expenses, we will use the rate as on date of transfer. The capital gain so computed in foreign currency shall be converted into INR by using the TTBR rate as on the date of transfer. Okay, only this much. This first proviso is not applicable when in case of section 112A. If the capital gain is taxable under section 112A, then first proviso benefit is not available. Then if the non-resident is transferring rupee denominated bonds, then any gain which is on account of appreciation of rupee, any capital gain which is on account of appreciation of rupee shall be removed. This fifth proviso section 48. So only two provisions relevant from under the chapter capital gain in respect of non-resident. Okay. So this is all for today's class. We have covered almost 60-70% of the non-resident chapter. The rest of the chapter we will discuss in the next class. Okay. So hope you understood the concepts. Yeah. If you like the video, do hit a like button, share with your friends, and keep studying. Take a very good care of your health. Your health is at most important, yeah, during this time, because it's a long race. It's not a small race. So it's not a you don't need. It's not that you need to study only for a day or two. It's a long race. You need to maintain good health, happy mood, keep smiling, be positive, and we'll see you in the next class. Till then, bye bye. Yes, sir.